evening and a very warm welcome to Personal Finance. I'm Gugulethu, Cele. Some view the ownership of a home as a measure of success. In the first half of tonight's episode, I sit down with Stephen Barker, Head of Home Loans at Standard Bank in South Africa, to get his view on property purchases in sub-Saharan Africa. Let's take a look. Let's get into this purchasing of a home. I think for many people it is an aspirational kind of purchase, but more importantly, one needs to go back to the affordability assessment and actually determine whether they can afford to buy a home or continue renting.
Yeah, so I think, generally, absolutely, the aspiration for most people is I want to own something that I can make my own. Generally, and too, when I own it, it feels as mine. I can customize it, to myself. So I think, if you start at the high level, it's obviously, you have to consider affordability. What can I afford financially? But also more importantly, it is the whole question around where does this, where am I buying? What's the location? How does it fit my work? How does it fit my play?
And I take it obviously that kind of question would be the same depending on which African state you might be living in. But let's go back to affordability. We all know that house prices in South Africa don't necessarily come cheap. You clearly need a substantial track record of income to actually prove that you can afford a home.
So I think absolutely. If you bring it into context, people always trade off often. A lot of people look at the affordability of, well, if I rent it, it's going to cost me this much. Would it be better to, to actually own? And I think the principle, particularly when you're looking at should I buy and should I own a property, is you can't be in the property market or own that asset, I'd argue, in the short term. So, if I don't know where I'm going to be living in, 2 to 3 years' time, perhaps you've got to sort of consider that because they're associated costs. But if we think about, I want to own this particular property, yes, what is it that I need? It would be great if people could save for deposits. I think deposits do help people. Banks most certainly look quite favorably on deposits. Tell us
about that just a little bit further, because how substantial does this deposit need to be? 5%, 10%?
So I think generally you probably, in an ideal terms, 20% would be great, but that could stretch quite far. And so I think any indication, generally you'd sort of find a good 10% deposit is a good place. So, if somebody's buying something, it's always better that they have a bit of money. But I think also there's also associated costs. So not only that deposit that you require, but there's also costs associated with, I'm going to have to sort of pay the taxes on this property. There's potentially conveyancing fees that have to be paid on a purchase. And then you've got to sort of move. There are other costs. So yes, the one thing is about buying the particular asset, but also one's got to think about what are the costs associated in actually purchasing this particular asset. Never mind that comes with the actual cost of ownership. And
in your experience, is that some of the typical mistakes that some of the South African clients make often, that you look at the price of the home and you think that you can afford it based on that, but like you say, there are all these additional factors that come into play which will impact your pocket quite negatively?
So I think when owning, what you do find is people right up front don't go in with the full understanding. But I'd argue those costs become, they show themselves quite quickly. So straight away, when you start to go down the chain, you figure out there's potential costs to be paid to, for the transfer duties. There's costs that have to be paid in terms of the legal fees. So those, I think, people understand those. I think the ones to worry about more and people to pay attention to more is what are the costs associated with actually owning a property. So you might think of the dead obvious ones, the electricity, the levies, the rates and taxes, but simple things like, a property only will continue to look as good as when you bought it if you maintain it. So there's also maintenance costs, which, people tend to underestimate. And where you buy could massively impact those, maintenance costs.
Goes back to the consumer asking questions. And I take it that kind of a relationship is obviously started once the consumer makes contact with the financier. Being a financial institution like the one that you represent, I've sat down, I come to you, I've found my dream home. Clearly there are obvious questions that you're going to ask me other than affordability. What do some of them entail?
Yes, I think large part of it is, and you're absolutely right, generally by that sort of stage there's already curtains been put on, put on the windows. The kitchen and, the sort of family living in the home is often the picture that people come to it. So I think the large piece of it is, yes, affordability is something, but also good credit track record. So in other words, somebody has shown experience that they have accounts, they manage them appropriately. I mean managing it appropriately, paying them on time, haven't incurred sort of bad debts where people have gone and, you know, sort of chased after them. So it is important, you know, that's going to be the second aspect of what's the credit track record. And then there is a degree where we would look at the actual property that is being purchased as, you know, as a background. You know, we would look at that as a potential collateral, you know, if something should go wrong. So that's also part of the decision.
Just on to sidestep for a moment, what about bank loyalty? Does that sort of add an element here? If I'm a Standard Bank client and I have a check account, a credit card, a personal loan with them, does that mean that you might give me favorable conditions when it comes to my home loan?
Generally, it absolutely does. So when you look at it, I mean, it's as a general rule of thumb, yes. But I think, you know, we have to look at each application, you know, as it comes through. And yeah, it could be in varying different sort of factors. The more we know of somebody, you know, not only might it mean that we say yes or no to a loan, but also the sort of interest rate we charge on that loan could also be more favorable.
We'll get into interest rates in a moment, but I want to pick up on a theme you mentioned, which is obviously affordability, a credit record, and like we've mentioned, some kind of loyalty towards the financial institution. We all know that banks don't want to take on too much risk, and that obviously goes back to how well you can afford to maintain the payments on this particular asset purchase. For individuals who are not full-time employees, do they find it more difficult at times to actually apply for financing for significant assets like a home or a vehicle?
So I think generally yes, you know, and I think a lot of that is due to the volatility. So when you're taking on, you know, a home loan or a loan as big as generally a home loan is, the financier would expect sort of monthly payments. And so as long as that sort of variability of income makes sure that those installments can be maintained and there's a track record, I think that's perfectly all right. But I do think we are sometimes, you know, we do find it a challenge when somebody comes in with highly variable income, and, you know, we've got to think about how this loan would be structured. And, you know, we don't want to get somebody, the last thing you want to do is put somebody into a property that eventually, you know, you're finding them having to sell it because, you know, due to financial strain, that they can't afford it. So straightforward, yes, but I think it does depend on general track record and affordability, but also variability of that income is probably what makes people look twice.
And I take it the obvious piece of advice that you'd give to a consumer like that is to save for a very substantial deposit to actually put down in their home.
I'd agree with that. I think absolutely it does make the decision you know, easier, but I also think that, you know, sort of credit background, if well conducted through time and shown, you know, sort of a general approach to sort of, you know, paying off debts and being responsible from an affordable and taking on what can be afforded, I think, you know, people should not find it, you know, that difficult. So while we get criticized often, there's a large percentage of our loans that we do, you know, for people that have got, you know, fairly variable income. So it's not that finance is impossible, it might just be slightly tougher.
Let's talk about the word that consumers like myself hate, which is interest. Unfortunately, it is needed to ensure that the financial institutions also make their bit in the environment. But coming back to South Africa, I know it's different for all the regions we have across the continent, but the big question that always comes up is to fix or not to fix. Let it be variable or not so. And given the current economic crisis that we're in South Africa, where many anticipate that we will see some kind of interest rate hike, is it too quick for consumers to start reacting to that news and panicking and coming to sit down in your office and saying, Stephen, fix it or else?
Yes, I think this discussion always is one where you have to sort of consider, you know, the individual's circumstance, and people need to reflect on, you know, what does it mean to me, you know, on a monthly basis. So in simple terms, if you want to fix your interest rate, you're going to pay some degree of, you know, premium or a slightly higher interest rate for the benefit of having it fixed for a certain period of time, which absolutely takes out the variability of interest rate movements, but you also pay an elevated interest rate for that period of protection. So for somebody who could potentially has the income and just looking for that certainty, I think absolutely, you know, there is something. But there's also a choice that you could say, well, why don't I just pay extra into my home loan full stop? The more I bring down the capital balance, the lower the interest rate charge would be. So yes, while you don't get the protection, you could find under certain circumstances, just by actually accelerating your payments, you get a slightly better than by fixing.
We like what you're saying too, because obviously this means that depending on how vast or how high these extra payments are, you'll actually end up paying off your home loan a lot sooner.
A lot sooner. Absolutely. And I think just to close out the piece where, you know, if I'm a consumer that my monthly finances are absolutely stretched and I run the risk that I might not be able to pay things if interest rates move, let's say, by 100 basis points, that protection is probably a good thing. But still come back to it as nowhere along the, you know, I think what some people underestimate is the power of why don't you pay a little bit extra. Effectively, every little bit of that you pay in extra will reduce that capital, which if on a disciplined manner and on a consistent manner, if somebody practices, they'll be quite surprised at how quicker the home loan actually repays, but also too the ultimate saving that it brings to them.
That was Stephen Barker, Head of Home Loans at Standard Bank South Africa. Stay tuned, because after the break we get a view from the west of the continent.